Good afternoon. You've just finished with your minor exams, and I have downloaded all the answer scripts and I will correct them and I will share the scores with you as soon as possible. And today's agenda is that we had started off with ratio analysis, so we will continue with that case study, and then of course we will do the numericals accompanying it. But before I begin, are there any doubts, any questions that you have? You may please ask. Also, two announcements I have to make. Samriddhi would be getting in touch with your CR and also sharing the feedback forms with you, either through Moodle or something. So I request all of you to fill that up. Also, the presentations that you were supposed to start making on 1st, that has been shifted to 5th. So you start your presentations only on 5th. And Samriddhi, please, I hope all of them know their groups and everything, and they also know the schedule in which they'll need to present, right?
Yes, ma'am. Yes, ma'am.
ठीक है. So you can get in touch with Samriddhi in case of any doubts, any questions that you may have. So these were the two announcements. And anything else before we get started? Okay. Cool. ठीक है. So I'm going to share my screen. Students, I was just sharing with Samriddhi that, Samriddhi, is this visible?
Yes.
ठीक है, thanks.
It is.
I was just sharing with Samriddhi that I was going through I've seen some 10-20 answer scripts, and it is so obvious that people who have been regular to class are the only ones who are scoring in double digits. Otherwise, everyone else is scoring 4, 5, 6, which is, pretty pathetic, but that is how it is. And there is a direct correlation between finance courses and grades, so that is pretty evident here as well. Okay, fine. So we were discussing the venture cash burn and build amounts and rates, and I'll carry on over here. And of course, if anyone has any doubts or questions, you may please unmute yourselves and ask, or you can write in the chat box or raise your hands. Samriddhi, keep an eye out for people who are writing a question or raising their hands so that we can address their concerns.
Sure, ma'am.
Thank you. Okay, so before we assess whether and how long a venture can survive on its current capital, it is important to calibrate how fast the venture has been expending cash and consuming capital reserves. For this calibration, the balance sheet and the income statement provide some very useful information. First, we look at a raw measure of how fast the venture is spending cash. To get this number, we need to calculate the actual disbursements of cash over a given period. One approach to calculating cash burn is to start with the cash disbursements related to the income statement's tracking of operating expenses, where we would exclude depreciation and amortization as non-cash expenses, interest expenses, and taxes. To these, we add increases in the inventories and subtract increases in non-interest bearing current liabilities accounts, that is payables and accrued liabilities. A final adjustment would be to add the amount of capital expenditures, that is increases in gross fixed assets. In summary, cash burn is the cash a venture expends on its operating and financing expenses and its investments in assets. So when we take a wholesome approach, cash burn is equal to the income statement based operating interest and tax expenses plus any increase in inventories minus any changes in payables and accrued liabilities, plus all your capex, that is all the investment expenses that you're making. The cash burn rate is the cash burn for a fixed period of time, typically a month. Okay. So for MPC in 2016, we first calculate cash operating expenses from table 5.1 as a sum of costs of goods sold, that is $380,000, admin expenses of $65,000, marketing expenses of $39,000, and R&D expenses of $27,000 for a total of $511,000. To this, we add interest expenses of $20,000 and income taxes of $8,000 for an income statement related total of $539,000. Changes in the relevant 2015 and 2016 balance sheets are taken from table 5.2. Inventories increased by 45,000 from 95,000 to 140,000. Accounts payable increased in 2016 by 27,000 from 57 to 84,000, and accrued liabilities increased in 2016 by 1,000, that is from 9,000 to $10,000. Gross fixed assets or capital expenditure increased in 2016 by 50,000 from $205,000 to $255,000. So using the cash burn equation for MPC, we have cash burn is equal to $539,000, that is 511,000 plus 20,000 plus 8,000 plus $45,000 minus $28,000, that is 27,000 plus 1,000 plus $50,000, giving us a total cash burn of $606,000. On a raw basis, MPC burned $606,000 in cash to pay expenses, build inventory, and buy equipment during 2016. Cash billed is what the venture receives on its sales. That is, cash billed is net sales less the increase in receivables. So in general, we have cash billed is equal to net sales minus increase in receivables. So for MPC in 2016, sales were $575,000 from table 5.1, and the increase in receivables was $30,000 from $75,000 to $105,000. Thus, we have an annual cash bill for 2016 of 575 minus 30 is equal to $545,000. The net cash billed rate is the cash billed for a fixed period of time, typically a month. Net cash burn occurs when the cash burn exceeds the cash billed in a specified time period. So in equation form, we have net cash burn is equal to cash burn minus cash billed. And typically for startups, this is the case. They have a net cash burn. Okay. So here also we see the same. The net cash burn is $606,000 minus $545,000, which is equal to $61,000. The net cash burn rate is the net cash burn for a fixed period of time, typically a month. Of course, a positive dollar amount would result in a net cash build and a net cash build rate. As we discussed in chapter 4, we also can use the statement of cash flows to determine whether a venture was experiencing a net cash burn or build position. If cash flow from operating activities plus cash flow from investing activities is positive, then the venture was building cash. A negative amount would mean a net burn position. A reference to table 5.3 shows that the cash flow from operating activities for 2016 was minus $11,000. Cash flow from investing activities, that is the increase in gross fixed assets minus plant and equipment, was minus $50,000. Thus for MPC, the net cash burn was equal to 11,000 plus 50,000, that is $61,000. Thus, both approaches calculated the net cash burn at $61,000 for MPC in 2016. For many, the preferred presentation of cash burn and build is on a daily, weekly, or monthly basis. For example, if we divide by 12, we have monthly cash burn rate of 606,000 divided by 12, which is 50,500, minus monthly cash build rate, that is 545,000 divided by 12, which is minus 45,416.67. And so the monthly net cash burn rate is 61,000 divided by 12, that is 5,083.33. So our net cash burn rate is frequently referred to as a venture's monthly burn rate. If we divide the year-end cash balance of $5,000 by the monthly net cash burn rate, we see that MPC had less than a month of cash left at the end of 2016. Concisely, MPC had 0.98 months until OOC, or out of cash. A typical use for this type of calculation is to approximate an answer to the question, if I invest 15,000, how long will it be before more financing is needed? For MPC in 2016, this number is about 3 months. So you would know exactly when you're going to run out of cash and when is the time that you need external financing. How long 15,000 will last in 2017 could differ significantly from the 2016 level. Nonetheless, awareness of historical burn rates and monitoring of ongoing burn rates provide important survival information to the new venture. Okay. So then we have beyond burn, which are the traditional measures of liquidity. So I am pretty sure that none of you have done any foundational courses in finance, so you may not know the other ratios, and that is why I've shared the MSL 302 material on ratios with you, so that you can go through it in detail. But here we'll be doing only those ratios which are applicable or relevant to a startup. Okay. So burn rates are calculated to deal explicitly with cash use and planning and are central to survival for the new venture. Several alternative measures that attempt to measure a venture's potential to produce and distribute cash are in widespread use among credit analysts. Instead of dealing with the balance of a cash account and the venture's tendency to deplete it over time, these measures, known as liquidity ratios, deal with the broader notion of liquidity by comparing assets that can be quickly converted to cash with liabilities that represents near-term needs for cash. Because these measures tend to be used to address long-term trends, not just surviving this week, they will be presented in versions that average beginning and end of period values. The first of these compares all current assets against all current liabilities. So this is a very, very popular ratio the world over. It's called the current ratio. This ratio is a simple indication of the margin of current assets over current liabilities. As previously noted, there is a preference for using averages, that is beginning of period amounts plus end of period amounts with the sum divided by 2 for balance sheet account data for rapidly growing ventures. When there are data availability constraints, however, financial ratios are often calculated using year-end balance sheet account data. So ideally, you should be taking like a daily average if you have daily figures, but very rarely do you have access to that kind of data. So you can take monthly figures and take a monthly average or quarterly averages, or simply if you don't have any other data, you can use opening and closing balances for the year, or you can take the year-end amounts also. So MPC's 2016 current ratio was calculated as average current assets upon average current liabilities, which is basically 250,000 plus 180,000, all the current assets, divided by 2 upon 204,000 plus 110,000, all the current liabilities, divided by 2, giving us a value of 1.37 times. A current ratio of 1 or more indicates that if all current assets could be converted into cash, they would be adequate to pay all current liabilities. Credit analysts believe current ratios above 1 indicate a liquidity cushion in the event that some non-cash current assets cannot be fully converted into cash. A ratio of 1.37 indicates that current assets provide a 37% cushion over and above current liabilities. Then we have what is called the quick ratio. Among current assets, inventories are viewed as being the least likely to be converted quickly into cash at the values recorded on a venture's balance sheet. Cash and marketable securities plus receivables, or current assets less inventories, comprise the liquid assets. Excuse me. The quick ratio measures the ability of liquid assets to pay current liabilities. The 2016 MPC quick ratio is calculated as average current assets minus average inventories upon average current liabilities. So we already know the figures of average current assets and average current liabilities. The average inventories are 140,000 plus 95,000 divided by 2. So we get a quick ratio of 0.62 times. A quick ratio of less than 1 indicates that the venture's liquid assets would not be adequate to pay off its current liabilities. Because the quick ratio for MPC was 0.62, a forced payment of the 38% gap would require liquidating inventories. So this is a precarious situation because in case the current liabilities are due for payment and the venture cannot meet the payment due to its low quick ratio, then the venture can actually run into a short-term credit crisis and it could also be declared bankrupt. The third liquidity ratio is net working capital to total assets ratio. Net working capital is nothing but current assets minus current liabilities. So an alternative way to calibrate liquidity considers a venture's net working capital, which is current assets minus current liabilities. Net working capital is a dollar amount measure of the cushion between current assets and current liabilities. A dollar amount, however, is difficult to interpret unless it is viewed relative to the overall size of the venture. So MPC's ratio of average net working capital to average assets was average current assets minus average current liabilities divided by average total assets. So this is, the average current assets and average current liabilities. The average total assets are 446,000 plus $343,000 divided by 2. So we get the net working capital to total assets ratio is 0.147 or 14.7%. The average net working capital for MPC was $58,000 when related to the average total assets of $394,500. The working capital buffer is a little less than 15% of the venture's total assets. The higher the percentages, the greater is the liquidity, other things being equal. An important qualifier on the conclusions drawn from any of the liquidity ratios is that receivables account balances are assumed collectible and inventories are assumed saleable. Okay, so naturally, we have to assume that inventory, whatever value we are using, that is actually saleable, and whatever receivables we are mentioning, that is actually collectible. So any doubts, any questions so far? Okay. Then how do we interpret the cash related and liquidity related trends? Now that we know several different ways to examine liquidity, we can consider MPC's cash and liquidity profile. Table 5.4 presents the 2015 and 2016 MPC burn rates and liquidity ratios. The venture's ability both to generate and to consume cash increased in 2016. MPC increased its cash generation by 122,000 or $10,167 per month, an increase of 28.8% over 2015. However, MPC's ability to spend cash grew at the significantly faster rate of 45.3%. Absent external financing, MPC net generated cash in 2015 and net spent it in 2016. Whereas 2015's year-end cash position appears to be of little concern, 2016 ends with the ventures having less than a month to live if something doesn't change. Okay, so here you can see how the burn rates and liquidity ratios have been computed for both the years, and we are now calculating the change in the percentage change. So you can see that the cash burn has actually increased and the percentage change is 45.3%. The same is the monthly cash burn rate. The cash build has also increased, but not in the same league as the cash burn. Okay, so the net cash burn has increased, and we are just seeing that the venture is growing very fast, and that's why it's using a lot of cash. And the monthly net cash burn rate has been calculated here. The year-end months of cash, we are seeing that we just have 0.98 months of cash left over here. The current ratio has actually come down, which is again a very alarming situation on the liquidity front. The quick ratio has also come down from 0.76 to 0.62. Okay, and the net working capital to total assets ratio has also come down, indicating that the liquidity position of the company has actually fallen. So by these ratios, it is evident and it is easy to see the liquidity position and how precariously the company is placed. Okay. The average monthly cash burn rate for MPC was 50,500 in 2016 compared to 34,750 in 2015. The change represents a 45.3% increase in the rate of cash outflow. Consistent with MPCs having filled the financial gap with a $5,000 depletion of cash and $56,000 of net new external debt, the current quick and net working capital to total assets ratios reflect a significant decline in liquidity during 2016. Whether increased burn rates and declining liquidity are a problem for MPC cannot be addressed without examining the reasons for the changes. This is an example of the manner in which financial analysis can lead to asking the right questions. If the venture is expanding, as its sales and investments in new equipment indicate, the changes may actually represent good fortune. Along these lines, 4,167 of the 5,583 increase in monthly net burn is due to the $50,000 capital expenditure. There were no capital expenditures in 2015. The increase left over is still 1,416 per month and is for the most part closely affiliated with another type of investment. MPC's extension of additional trade credit and building of inventories heavily outstripped its ability to take down its own trade credit. Intermittent capital expenditures and increased investments in inventories and the extension of trade credit can easily distort simple comparisons. Nonetheless, however justifiable the cause of the gap, it is a sign of pressing financial needs. But this is something that ventures have to undergo, because when you're trying to grow rapidly, when you're trying to expand your operations, you will spend on capital expenditures, you will spend on inventories, and you will be burning cash. And that is the reason why startups need so much of financing in the beginning. In summary, while MPC's burn rate and liquidity aspects appear to have weakened in 2016, the venture still has a lot going for it. Sales and assets are increasing rapidly and the venture is profitable, albeit at a lower level than in 2015. To enjoy success, MPC needs to take extreme care in supplying the cash needs associated with growth. Okay. So any doubts, any questions in the liquidity ratios so far? Okay, so these were the three very important liquidity ratios: current ratio, quick ratio, and the net working capital to total assets ratio. Now we come to the second bucket of ratios, which is called leverage ratios. Let's see what they are. Leverage ratios indicate the extent to which the venture has used debt and its ability to meet debt obligations, basically long-term debt obligations or financial obligations. When a venture takes out a loan or otherwise formally borrows money, it generally promises to repay the amount borrowed and an additional amount of interest. The loan principal amount is the dollar amount borrowed. Interest is an additional dollar amount paid to the lender in return for lending money to the venture. By borrowing, the venture gives the lender a superior claim on venture income and assets. Straight debt lenders, almost without exception, get paid before founders and venture investors. Many venture financing arrangements have elements of debt and equity and therefore may not fall conveniently into categories that permit analysis. Nonetheless, it is good to start with the traditional counterpoint of debt versus equity. So whereas liquidity ratios were helping you understand the short-term liquidity position of the company, the leverage ratios help you understand the long-term debt obligations, the long-term financial or solvency position of the company. And whenever a startup or any company goes to the bank for a loan, these are the ratios that bankers focus on when they're evaluating the company for a possible loan. So let us look at these ratios. Measuring financial leverage. So the first ratio in this category is total debt to total assets ratio, also called debt to assets ratios or DA ratios. By comparing a venture's total debt, that is current liabilities plus long-term debt, to its total assets, we can construct a quick picture of how much of the venture has been pledged to debt holders and how much is supported by equity. The more that has been pledged, the higher is the risk that a pledge will be broken. Subsequent to the broken pledge, the debt holders will control the enterprise. We will calculate the total debt to total assets ratio using beginning and ending period averages for current liabilities, long-term debt, and total assets. MPC's total debt to total assets ratio in 2016 was average total debt upon average total assets. So the average total debt was basically all your average current liabilities plus long-term debt. So that is 204,000 plus 110,000 divided by 2 plus 80,000 plus 90,000 divided by 2 upon average total assets, which is 446,000 plus 343,000 divided by 2, which gives us a total debt to total assets ratio of 0.6134 or 61.34%. According to the accounting notion of book value, approximately 61% of MPC was pledged to debt holders and other creditors, leaving 39% to equity holders. An interesting conceptual viewpoint adopted by some academics is that the venture has really been sold to the debt holders in return for proceeds of the loans and an option to buy the venture back for the amounts specified in the debt agreement. If the venture owners can marshal enough cash to pay interest and principal obligations on time, then the option to buy back the venture is considered exercised and the venture is re-owned by the holders of its equity. While this viewpoint has some advantages in emphasizing the potential loss of control and ownership associated with debt financing, by law, the owners are in control of the venture's operating and financing decisions until debt obligations are breached and formal legal proceedings have placed control elsewhere. Okay, so this has a legal ramification for the venture. Frequently, entrepreneurs have the impression that debt financing is the best method because they retain control. While this argument has merit, when financial difficulties arise, the venture would almost always be better off dealing with a few equity investors who have voting rights, rather than with debt holders who have recourse to court bankruptcy actions affecting the control of the enterprise. As we will discuss later, it is not uncommon for venture investors to buy equity and thereby commit to forego the legal protection offered to debt holders through federal and state bankruptcy statutes. So here we look at another ratio which is called the equity multiplier. This ratio summarizes the venture's debt position from a different vantage point, total assets divided by owner's equity. It shows the magnification of equity injections into amount of assets. So for MPC in 2016, the equity multiplier was average total assets upon average owner's equity. So which is, we already know the value of average total assets. Average owner's equity was 162,000 plus 143,000 divided by 2, which is 2.587 times. Then we have another ratio which is called current liabilities to total debt ratio, which is nothing but average current liabilities upon average total debt, which gives 0.6488 or 64.88%. So this basically shows that MPC had nearly 65% of its debt in the form of current liabilities. Now this is very true for any large manufacturing concern. There you would find that current liabilities constitute a greater portion than long-term debt when you look at total debt. A high total debt to total assets ratio coupled with a high current liabilities to total debt ratio makes it more likely that the venture will encounter debt repayment problems. So these ratios so far told us about the degree of leverage, that is, what is the amount of debt that is involved in the functioning of the enterprise. Now the other ratios will tell us about the debt repayment capacity or capability that the company has. So the first amongst the debt payment ratios is interest coverage. Interest payments represent the most frequent type of debt flow facing a borrower. As long as interest payments are made, the principal amount frequently can be rolled over with an existing or new lender. A reasonable question is, how big is the cushion between a venture's ability to generate cash to pay interest and its interest obligations? To calculate interest coverage, we divide a venture's earnings before interest, taxes, depreciation, and amortization by the annual interest payment. Interest is paid before taxes, and because depreciation and amortization do not involve the outflow of cash, we use earnings prior to both taxes and depreciation, and of course before interest. For MPC in 2016, the interest coverage ratio was EBITDA upon interest. So EBITDA was 47,000 plus 17,000 upon the interest charges, which were 20,000, which gave us an interest coverage ratio of 3.2. This means that MPC's income before depreciation, interest, and taxes could have fallen to one-third of its current level without affecting MPC's ability to pay interest. So suppose there's a recession and the EBITDA falls by 66% or two-thirds, even then the company would be able to repay its interest obligations. Okay. The second ratio is fixed charges coverage ratio. Now, interest payments are often not the only payments that need to be made to creditors. For instance, if a venture decides to rent or lease equipment or buildings, periodic or often monthly payments must be made. Missing payment on these types of fixed charges has similar consequences to missing interest payments. Also, many debt arrangements stipulate that a portion of a loan's principal amount or balance must be regularly repaid. One example is a commercial bank's term loan that requires periodic payments of interest and principal. Even when businesses borrow for the long term by publicly selling bonds, they often are required to make sinking fund payments that can be used to retire their bonds gradually. So here again, you look at the leverage ratio performance. Over here, we have the total debt to total assets ratio, the equity multiplier ratio, the current liabilities to total debt ratio, and then we have the payment ratios, which are interest coverage ratio and fixed charges coverage ratio. As you can see, we have figures for 2015 and 16. So the total debt to total assets ratio is actually increased, which shows that the leverage has increased and hence it is more risky for the company because they might face solvency issues in case they're not able to repay their total debt to total assets. The equity multiplier has also increased marginally, but you can see that because the total debt to total assets has also increased, the overall impact on leverage risk has increased. The current liabilities to total debt has also increased substantially. So here again, there is a greater risk on the company in terms of the financing that they have done through debt. The interest coverage ratio has actually come down, which is again an alarming situation. Okay, and it has increased in the leverage risk. The fixed charges coverage ratio has also come down, which again increases the leverage risk. So just by highlighting the values of these 5 ratios, we are able to see whether the company is becoming riskier or is it a safer investment for uh, the promoters and investors. Okay, so this is the second bucket of ratios, which is called leverage ratios. There are many more ratios, students, in both current ratio and leverage ratios, but here we are giving you only those ratios which are relevant to a startup. The third bucket of ratios is called profitability ratios. Probably the most popular ratios which you come across in newspapers or on TV when they're talking about companies. And this is what investors look at when they're trying to evaluate a company for investment. So the first ratio here is called the gross profit margin. Do the venture's revenues exceed the cost of the goods being sold? For many new and high growth ventures, the answer to this question is no. The potential offered by growth ventures can be a temporary excuse, but eventually the venture will have to create more revenues from a product than the cost to produce it, or the venture will collapse. The venture's gross profit margin or earnings margin is calculated by dividing the gross profit, that is net sales minus COGS, by the venture's net sales or revenues. For 2016, MPC's gross profit margin was gross profit margin is equal to net sales minus COGS upon net sales, which is 195,000 divided by 575,000, which comes out to be 0.3391 or 33.91%. This means that MPC spends about 66% of its sales covering costs of production. This 34% gross profit margin in turn must be adequate to cover all other expenses if the venture is to be profitable. Then the second ratio that we have is called operating profit margin. The operating profit margin is calculated by dividing the venture's operating income, measured as the earnings before interest and taxes, by the venture's net sales. So MPC's operating profit margin for 2016 was EBIT upon net sales, which is 47,000 divided by 575,000, which is equal to 0.0817 or 8.17%. Thus, MPC earned a little more than 8% operating profit margin on its sales after covering production and other operating costs. If a venture can also cover financing costs, which is primarily interest expenses, and pay the tax bill, it will experience a net profit. Okay, this by itself is not a very encouraging ratio. Then we come to the final net profit margin, which is what we hear about, net profit margin or EAT, earnings after taxes. The 2016 bottom line for MPC's owners is whether MPC made a profit after all expenses have been taken into account. As a venture matures, a net income or net profit is an increasingly critical source of financing. Remember that net income is the first source of cash found in the statement of cash flows. So MPC's 2016 net profit margin was net income upon net sales, which is 19,000 divided by 575,000, which comes out to be an abysmally low amount of just 3.3%. Now, the reason why I'm saying this is because even today, if you put your money in a savings bank account, even that will give you more than 3.3%. Okay. So why should you undergo taking a lot of risk, setting up a new company and everything, when it is eventually only going to give you 3.3%? So MPC averaged earnings of little more than 0.03 or 3 cents on each dollar of sales. But as I said, when you're starting off, when you're in the survival phase, this is the kind of rates that the ventures will give you if they don't actually give you a loss. And it is only after they get into the rapid growth stage that they will start giving you amazing returns of more than 50%. Okay. Then we have another ratio which is called no PAT margin. Okay. Directly comparing bottom lines between two ventures with different amounts of financial leverage can lead to tax-related distortions in relative performance. The tax deductibility of interest creates an interest tax shield equal to the tax rate times the interest payment. This part of profit is merely a government gift for using debt instead of equity. One approach to level the playing field is to find the profit each firm would have had in the absence of financial leverage, that is after restating taxes to what they would be if interest were not tax deductible. This is commonly referred to as NOPAT, which is net operating profit after taxes measured as EBIT times 1 minus the firm's tax rate. Dividing a firm's NOPAT by its sales results in a NOPAT margin profitability measure. MPC's NOPAT margin for 2016 was NOPAT is equal to EBIT into 1 minus tax rate upon net sales. So this is nothing but 47,000 to 1 minus 0.30 upon $575,000, which gives us a NOPAT margin of 5.72%. If one is interested in operating performance in the absence of financial leverage, MPC's NOPAT margin of 5.72% may be a better ratio to compare with other ventures taking different approaches to the use of financial leverage. Okay, so this is just to look at what would be the NOPAT margin in the absence of how the company has financed its operations. Any doubts, any questions so far? Let me just have a sip of water while you think about it. Okay, so now we come to the fourth bucket of ratios, which is called efficiency ratios. They are also called turnover ratios, activity ratios, because they all indicate the activity levels or the efficiency levels of a company. So the first ratio in this category is sales to total assets ratio. Ideally, it would be great for MPC to be able to generate revenues without having to invest in any assets. Growth would be uninhibited and financing needs would be trivial. Unfortunately, such firms are few and far between, irrespective of what the latest infomercial tells you. Running a business with no money down is rare. It is far easier to think of examples of industries that require massive asset deployments before generating a single dollar of revenue. An electric utility company undertakes phenomenal investments in assets to generate the first dollar of revenue. Nuclear energy production is perhaps one of the most extreme examples of the lag between cash outlay and revenues. There are industries that do not require large investments in assets, for example, a travel agency. Unfortunately, the travel agency industry, because of low required asset investment, is wide open to other newcomers. Large required asset investments are a blessing and a curse. So if you have a large asset requirement, then very few people would be able to meet that kind of investment, and that is why there are fewer players. If you are running a service sector or say a travel agency, then the investment required is pretty low, but then you'll have many travel agents right next to you opened in the same localities, so the competition becomes very fierce. So it's both a blessing and a curse. The same thing that makes it difficult for you to enter prohibits others from entry. Ultimately, for a given industry, the objective is to use assets as efficiently as possible within the range of discretion provided by the industry. The sales to total assets ratio is calculated as net sales or revenues divided by average total assets. It is particularly important to use average assets because growing ventures can add significantly to the asset base in a period, and if not taken into account, will distort the apparent efficiency of asset utilization. So MPC's sales to total assets, which is also called asset turnover ratio or asset intensity ratio, for 2016 was net sales upon average total assets. That is, how much of sales are your assets turning over in a year? Okay. So this is equal to 575,000 divided by 446,000 plus 343,000 divided by 2, which is 1.458 times. So MPC was able to create 2016 sales of about 1.5 times the asset base. Now, some analysts also calculate a number of efficiency ratios, something over net sales for specific current assets, including receivables and inventories. We have chosen to measure the efficient use of receivables and inventories within the context of the C3 discussed earlier. Because cash production and depletion is the key to a new venture survival, we believe it is best to examine the efficient use of receivables in that context. Note that the sale to cash conversion period can easily be interpreted as a measure of the efficiency of receivables in generating sales. Students, just give me a minute. I'll be just back. Just a minute. Okay, everyone. Um, then we come to the operating return on assets ratios, which is basically EBIT upon assets. Every venture must be able to generate profits from operations if it is to survive. Previously, we calculated the operating profit margin as EBIT divided by net sales to measure the venture's profitability from operations before financing costs and tax payments. We can also calculate the operating return on average assets, which is sometimes called the venture's basic earning power. The MPC calculation for 2016 is EBIT upon average total assets, which is 47,000 divided by 446,000 plus 343,000 divided by 2, which is 11.91%. Okay. So this is called the operating return on assets, also called the basic earning power. So MPC earned nearly 12% on the average assets outstanding in 2016. The higher the venture's basic earning power, the more easily it can cover interest expenses, pay its taxes, and produce profits for its owners. It is important to note that the owners of the venture benefit from the use of borrowed funds as long as the effective interest rate is less than the venture's operating return on assets. For example, MPC's interest costs in 2016 were $20,000. Average short-term debt was $77,000 and average long-term debt was $85,000 for total average interest-bearing debt of $162,000. Because this rate was higher than the venture's basic earning power, the owners of the ventures were worse off because they used debt to increase their scale when the earning power didn't even cover the increased debt costs. MPC's resulting net profit margin was only 3.3%. Then we come to another very popular ratio, which is called return on assets or ROA ratio. A third ratio combining data from the income statement and the balance sheet relates net income to average assets. This ratio has the useful property that it can be treated as a product of net profit margin and sales to total assets. The direct calculation of ROA is net profit divided by the average total assets. So return on assets is net income upon average total assets, that's 19,000 divided by 446,000 plus 343,000 divided by 2, which is 4.8%. Okay. Now here I want to give a caveat to my students who may or may not understand this because you don't have a background in finance. See, for a typical startup, it is typically financed by equity, okay, and there is very little debt component in the beginning. However, as a company continues to grow and it starts deploying debt, please understand that the average total assets are generated both by the equity finance portion as well as the debt finance portion. So the net income or EAT or net profit is the money that comes to the equity providers. But the debt providers also get something, and that is called interest. However, as all of you know, interest is allowed as a tax deductible expenditure, even though it's just a financing expenditure, not an operating expenditure. So this formula actually becomes net income plus interest into 1 minus T, where T is the tax rate upon the average total assets, because your average total assets are financed both by equity as well as your debt provider. So we should look at the return for both of them. Okay. Then rather than calculate ROA directly, we can indirectly calculate the ratio using the ROA model, where ROA decomposes into the product of the net profit margin and the sales to total assets ratio. Now, this version of the ROA is also called the DuPont two-point ratio, and it was developed by the DuPont company. It was first used by them, and after that it has become very popular along the finance discipline as well as the strategy discipline. This is basically ROA split into two ratios. One is net income upon net sales, which is the net profit margin, into net sales upon average total assets, which is basically the asset turnover ratio. So this becomes 19,000 by 575,000 into 575,000 divided by 446,000 plus 343,000 divided by 2. Here again the net sales cancel out, and we are left with the return on assets ratio, which becomes 0.0330 into 1.458, which is 0.048 or 4.8%. The advantage of this breakout is that it simultaneously presents a venture's ROA as a joint outcome of two distinct aspects of a venture's operations: the ability to create sales from assets and the ability to carve a profit out of those sales. Then we have the ROE, again a very popular ratio, the return on equity. Ultimately, the entrepreneur and other equity investors are interested in the rate of return they have earned on their investment. At this time, we calculate single period returns using accounting information. For a venture organized as a corporation, owner's equity often is referred to as shareholders' equity, which may comprise a common stock account and accumulated retention of profits account, referred to as retained earnings. The return on owner's equity is calculated as a net income or profit divided by the average owner's equity. The MPC calculation for 2016 is return on equity, which is equal to net income divided by average owner's equity, which is 19,000 divided by 162,000 plus 143,000 divided by 2, which comes out to be 12.46%. This shows that MPC earned a return of about 12.5% on its 2016 average equity investment. Notice that the ROE is larger than the ROA. With the use of debt, the venture can purchase more assets than it could with equity alone. Any additional return on these assets enhances the total return and improves the ROE. Similarly, any losses on these additional assets decrease the total return and harm the ROE. This is the basic magnifier effect of financial leverage. Good returns are better, bad returns are worse. The ratio of ROE to ROA gives the equity multiplier view of financial leverage. For MPC in 2016, the equity multiplier was 0.1246 divided by 0.0482 or 2.59 times. A useful relationship between the ROA model and the related ROE model, in which ROE decomposes into the product of net profit margin, sales to total assets ratio, which together is the ROA, and the equity multiplier, is given here. Now this ROE ratio is also commonly called the DuPont three-point ratio. Okay, and it's known as such across the world. Now, using the previously calculated ratios for MPC for 2016, we have an ROE of 3.3% into 1.46 into 2.59, which is 12.5%. Okay. So these are some of the very, very popular efficiency and return ratios. Now let us look at how we interpret these ratios. So table 5.6 shows a comparison of several profitability and efficiency ratios for MPC for 2015 and 2016. All profitability measures declined between the 2 years. The gross profit margin declined from about 35% to about 34%, indicating that MPC's cost of production increased 1% from 65 to 66%. So MPC's profitability, efficiency, and return measures are given here. For the 2 years, 2015 and 16, you can see the gross profit margin, operating profit margin, net profit margin, the no PAT margin, the sales to total assets, the operating return on assets, the ROA ratio, and the return on owner's equity. So over here you can see that the gross profit margin, the operating profit margin, the net profit margin, the no PAT have all lowered. Okay. The sales to total assets ratios actually increased, whereas the operating profit to ROA and return on owner's equity has actually come down. Okay. The operating profit margin declined sharply from about 9.6% to 8.2%, indicating that some or all of the operating expenses, which are administrative, marketing, and R&D, increased more quickly than sales. We can examine this lapse in greater detail by considering each expense as a percent of sales and comparing it to 2015 levels. MPC's operating expenses as a percent of sales in both years were admin expenses, marketing expenses, R&D expenses, and a total of 22.2 in 2015 and 22.8 in 2016. Thus, in addition to the increase in the cost of goods sold as a percent of sales, reflected in a decreased gross profit margin, the overall operating profit margin suffered from an additional increase in admin expenses as a percent of sales. The margin decline would have been even more dramatic except for a decline in marketing expenses as a percent of sales. On the positive side, MPC's sales to total assets ratios increased in 2016 from 1.33 to 1.46. However, the decline in the net profit margin from about 4.8% to 3.3% more than offset the improvement in utilization of assets, causing the ROA to drop from 6.4% to 4.8%. The increase in financial leverage reflected in the increased equity multiplier was not enough to prevent a decline in MPC's ROE from 15.9% to 12.5%. Okay, so this is how you interpret the ratios, this is how you connect the dots and try and get some sort of a picture about the company based on the numbers that it shares. Then we have industry comparable ratio analysis. Up to this point, we have stressed the use of trend analysis to examine and monitor the financial health of a new and growing venture. Table 5.7 shows selected average ratios for existing firms operating in MPC's industry. As previously indicated, industry data are sometimes difficult to find and may be incomplete. This is particularly true for new industries where we often find intense entrepreneurial activity. For MPC, however, we have industry data. MPC compares poorly with the industry averages for 2015 and 2016. We showed earlier that cash burn rates could be calculated directly from the income statement, balance sheet, and statement of cash flows. To provide comparables on burn rate, we would need to find those statements for competitors in the industry. For the other standard financial ratios, finding comparable data is usually less difficult because industry associations and accounting firms frequently track the standard ratios. So for the standard ratios, you have enough reports, enough three-party consultancy reports that cite these ratios publicly. Okay, so they are available publicly. MPC's total debt to total assets ratio is a little higher than the industry average of 60%. Consistent with this, the venture's interest coverage ratio is below the industry average. Profitability ratios indicate that MPC was underperforming relative to the industry average for 2016. MPC's apparently higher cost of production and other expenses led to an operating profit margin significantly below the industry average of 10%. So as you can see here, we have MPC's industry, the MPC's ratios in 2016 and the 2016 industry average. And when we do a comparison with the industry, we find that it has lower liquidity ratios compared to the industry. It has higher leverage ratios. In fact, it has lower interest coverage ratios than the industry. So even if it is just using the industry average as a benchmark, it still has to go a long way. In terms of profitability ratios also, the average industry ratio is much higher than what the company is making. In terms of efficiency and return ratios, again, the company is performing far below the industry average. So this is a good time for the company to learn from the best industry practices available in the market and try and do what the industry or the best players in the industry is doing to be able to improve their performance. Lower profits from operations and a lower utilization of assets, as reflected in the sales to total assets ratio, contribute to the relatively lower ROA for MPC. MPC's return on equity lagged behind the average return to owners of other firms in the industry. Okay, so this is just an example of some of the most commonly used ratios in relation to startups through an example of MPC, and we also looked at the interpretation of these ratios, and we also looked at a industry comparison with these ratios. So any doubts, any questions so far? Okay.
Excuse me, ma'am.
Yes, Sharon?
Ma'am, could you explain the part where you said that when as a company grows, there is a debt component involved, and so you said that we would have to incorporate the interest as well along with
Yes.
the net income.
Yes, Sharon. So, Sharon, when we are looking at the total assets of a company, naturally it is not only, it's not simply financed just by equity, right? I mean, you take loans to buy assets of a business as well, right? Are you with me so far?
Right.
Sharon?
Yes, ma'am.
Okay, you do understand that the total assets, suppose you look at a large company like Reliance, then naturally all its assets have not been funded simply by the promoter's equity, but they've also been funded through debt, right? Through loans and all.
Right.
Now, in a startup, because they have just started off and they don't have enough operating history, they don't have stable income, they don't have enough assets to use as collateral, it is very difficult for a startup to raise debt, to raise loans. Okay, so typically in a startup, it is basically 100% equity financed. Are you okay with that? Are you with me
Yes.
so
Yeah.
far? So that is
Yes,
why
ma'am.
in these ratios for startups, we have only used net income, which is basically the net profit that belongs to the equity providers. And we have completely ignored the debt providers. However, I told you that once the company starts getting into the rapid growth phase, it would be able to then start raising debt. And then your total assets would be financed not just by equity, but also with debt. So when we are calculating return on total assets, then total assets have to give a return not just to the equity providers, but also to the debt providers who have given them loans to finance their assets. And hence the numerator will become net profit plus interest into 1 minus T, where T is the tax rate. I into 1 minus T indicates the net effective cost of debt for the company. Okay, Sharon?
Yes, ma'am. Thank you.
Okay, I have also shared a detailed document on ratio analysis, which I teach to my BTech students who do a minor degree in management when they do a foundational course in management accounting and financial management. Please feel free to go through that. It details out all of this in much greater detail. Okay, And I've shared that with all of you simply because most of you have not done any core courses in finance. Okay.
Yes, ma'am. Thank you.
So go through that, and even after reading that, in case you have any doubts, any questions, you can always get in touch with me. Okay. Anyone else who has a doubt or a question? Okay, so just like the other chapters, let us do some numericals here. So the numericals have been already solved by Samriddhi and they have been shared with you as well. But let's do some of them in class so that you're familiar with how to solve the numericals that come in this. Okay. Okay. So the first ratio, as you can see here. So Samriddhi, this is what I was saying, the typing of these questions along with the numericals
Yes, ma'am.
in that
I
Word
got it.
document only, and then we can
Yes.
convert everything into PDF so that everything is together in one place.
Okay, ma'am.
Okay. Thanks, sir. Okay, so this first question deals with the calculation of the ROA and ROE and the ratio components. So we look at a company called the Salza Technology Corporation, which successfully increased its top line sales from $375,000 in 2015 to $450,000 in 2016. Net income also increased, as did the venture's total assets. You have been asked to compare the financial performance between the 2 years. So we have this data given to us, Salza Technology Corporation, the annual income statements in $1,000 for 2015 and 2016. So as you can see, the net sales have been 375,000 in 2015, less COGS, which gave us the gross profit of 150,000, less operating expenses of 46,000, less depreciation of 25,000, less interest of 4,000, which gave us an income before taxes of 75,000, less taxes worth 20,000, which gave us a net income of 55,000. And the company also declared cash dividends of $17 in that particular year. Similarly, we are given the annual income statement for 2016 as well. Then when we look at the balance sheet for the 2 years, we start with the current assets, that's cash of $39,000, accounts receivables of 50,000, inventories of 151,000, which gives us a total current assets of 240,000. To this, we add the gross fixed assets less accumulated depreciation, that is 105,000, to get total assets value of $345,000. Then we start with the current liabilities of account payables of 30,000, bank loan of 20,000, accrued liabilities of 10,000, total current liabilities of 60,000. So this gives us a total current liabilities of 60,000. To this, we add the long-term liabilities of long-term debt of 15,000, common stock of 85,000, and retained earnings of 185,000 to give us a total liabilities and equity of 345,000. Similarly, we are given the values for 2016 as well. Now, based on this, let me come to the second page. Now, based on this data, just a second. We are to calculate the following ratios. A, calculate the net profit margin and the sales to total assets ratio for Salza for 2016 using average total assets. Also calculate the return on total assets in 2016 using average total assets. B, calculate the ratios in the ROA model for both 2015 and 2016 using year-end total assets. Comment on any financial ratio differences. C, expand the 2016 ROA model discussed in Part A into an ROE model that includes financial leverage as measured by the equity multiplier. Use average owners or stockholders equity in your calculation. D. Expand the 2015 and 2016 ROA model calculations in part B into ROE models based on year-end owners or stockholders equity amounts. Okay. So let us see how this is solved. So here is the compilation of all the information that is relevant to us. We have net income of 2016 70, net income of 2015 of $55,000, net sales in 2016 of 450, total assets of 2016 at 465, total assets of 2015 at 345, and the average total assets are nothing but the two total assets divided by 2, that is 405. The owner's equity of 2016 is 355 plus owner's equity of 2015 is 270. So the average owner's equity is again an average of these two figures, that is 312.5. Now based on these numbers, we have to calculate the net profit margin to sales to assets ratio divided by return on assets. So first we calculate the net profit margin, which is nothing but net profit divided by net sales. So that is 70 divided by 450, that is 15.56 for 2016. And the sales to total assets ratio is net sales divided by average total assets. So net sales is 450 divided by 405, that is 1.11 times. Okay. Then the return on total assets ratio is net income divided by average total assets. So that is 70 divided by 405, which is 17.28%. Now these are based on average figures, but when we are asked to calculate the ROA for 2015 and 2016 using the year-end total assets figures, then you can see that ROA for return on total assets for 2016 is net income upon total assets in 2016, which is 70 divided by 465, which is 15.05%. And return on total assets in 2015 is the return in 2015 upon total assets of 2015, that is 55 divided by 345, which is 15.94%. So despite the increase in net income in 2016, the ROA in 2016 was less than 2015 ROA due to the increase in investment in total assets. So even though the net income actually increased in 2016, yet the return on total assets was lower than 2015 because we have also increased the investment in total assets. Okay, so this is the interpretation of this ratio. Then you have to, in part C, you have to calculate the ROE for 2016. So that is nothing but ROA for 2016 into the equity multiplier. So that is 17.28 into average total assets upon average owner's equity. So that is 17.28 into 405 divided by 312.5, which gives us an ROE of 22.39 times. Or it can also be taken as the percentage. So ROE using year-end owner's equity is the ROA into the equity multiplier. So we take the actual year-end figures of 2016. So this is 15.05 into 465 divided by 355, which is 19.72 in 2016. And the ROE calculated in 2015 is ROA into equity multiplier, that is 15.94 into 345 by 270, that is 20.37. So as all of you can see, these are very direct formula based kind of numericals. You just have to remember which ratio you're calculating and how you calculate it, and just use the data given in the tables to calculate the ratios. Okay, so very easy. Okay, then let us look at the other questions. So okay, fine. So the second question deals with liquidity and financial leverage ratios. So refer to the Salza Technology Corporation in problem 1. A. Using the average balance sheet account data, calculate the current ratio, the quick ratio, the total debt to total assets ratio, and the interest coverage ratio for 2016. Repeat the ratio calculations requested in Part A separately for 2015 and 2016 using year-end balance sheet account data. What changes, if any, have occurred in terms of liquidity and financial leverage? So here we are dealing with the other two buckets of ratios. So let us see how that pans out. Okay. Now here again, the information has been collated here again. For 2016, the current assets were 300,000, current liabilities were 95, inventories were 204, the long-term debt was 15, the gross profit was 180, operating expenses were 46, interest was 4, and the total assets were 465. And similarly for 2015, again we have collated this information. Now, based on this information, we have to calculate the following ratios. So, using the average balance sheet account data, the current ratio would be average current assets upon average current liabilities. So, we've added up the average current assets, 300 plus 240 divided by 2, divided by the 95 plus 60, which is the average current liabilities divided by 2, which comes out to be 540 divided by 155, which is 3.48 times. Prima facie, it's evidence of good liquidity. Then we calculate the quick ratio. Quick ratio is nothing but average current assets minus average inventory upon average current liabilities. So we know the average current assets values, we know the average current liabilities values. The average inventory is 204 plus 151 divided by 2. This is subtracted from the average current assets. The value becomes 185 divided by 155, that is 1.19 times. Then the third ratio is the total debt to total assets ratio. So this is average total debt, which is average current liabilities plus average long-term debt divided by average total assets. So when we apply the figures here, it comes out to be 155 plus 30 divided by 2 divided by 810 divided by 2. So that is 185 by 810. Is this Samriddhi?
Ma'am?
Samriddhi, is this correct? This 810 divided by 2, it shouldn't be 810 here again. Na? Just run a calculation of this
Yes.
0.2284.
Yes, ma'am. I will run it again.
Okay, okay, just check that. Huh? In case oh, we may have to correct this figure.
Yes, ma'am.
Okay, and the same goes for the quick ratio also, divided by 2 wala jo cheez hai.
Yes, ma'am.
Okay. Fine. So then we calculate the interest coverage ratio, which is EBITDA upon interest. That is gross profit minus operating expenses upon interest. So we have EBITDA is equal to 180 minus 46 divided by 4. That is 134 divided by 4. Is 33.5 times. So the company is actually doing very well and it can actually take up more debt as well. Then when we use the year-end balance data, then the current ratio for 2016 becomes current assets by current liabilities. That is 300 by 95, that is 3.16 times. The current ratio for 2015, the same figures for 2015, 240 divided by 60, that is 4 times. The percentage change in current ratio, as you can see, is minus 26.58% from 2015 figures to 2016 figures. So the liquidity has actually gone down. Then we calculate the quick ratio of 2016, which is current assets minus inventories upon current liabilities. So that is 1.01 times. And the quick ratio of 2015 is current assets minus inventories upon current liabilities. That is 1.48 times. Again, we can see that over the year, the actual quick ratio has come down by 31.76%. So, by looking at these ratios, we can say safely that there has been a substantial decline in liquidity from 2015 to 2016, as can be observed from percentage change in current and quick ratio from 2015 to 2016. Okay. This is the second ratio. Then we look at total debt to total assets ratio of 2016. That is total debt upon total assets, which is 0.2366 or 23.66%. And for 2015, the value is 60 plus 15 divided by 345, that is 21.74%. We can see clearly over here that there has been increase in the total debt to total assets ratio. Then we have the interest coverage ratio, which is EBITDA divided by income. So that is 150 minus 46 divided by 4, which is 26 times. Although there has been an increase in total debt to total assets ratio, the interest coverage ratio has also increased substantially. So this is basically showing that even though we have taken more debt and we've increased our assets, the interest coverage ratio has also increased, showing that our earnings are also increasing accordingly. Okay. Is there someone who has unmuted themselves? There is some Samriddhi. Is this noise coming from your side?
Yes, ma'am. I just realized that my mine was open.
हाँ तो उसको म्यूट कर लो please. Okay, thanks. Fine. So this is the other numerical. Now let me show you the others. We will upload all of this so that you can do your own practices. So I think question number 3 you can solve on your own, because it is asking you to calculate the current ratio, quick ratio, total debt to total assets, net profit margin. All of this we have done. So I think you can solve it on your own also. Would you like to solve it right now, or would you like to solve it later as homework? Sharon or Aniket or Naman or Nirod, anyone? Naman to bhagi gaya. Batao, would you like to solve it right now in class, or would you like to solve it on your own at your own time? बोलो अनिकेत, अनिरुद्ध, शारन. लगता है सब
Yes, ma'am,
ऑनलाइन
we
वो
could solve
करके
it
और
now.
फिर. हाँ शारन.
Ma'am, we could solve it now.
Okay, okay. Then why don't you try solving this? Is this visible to you?
Yes, now it is.
Okay, let me increase the font size also, and it is also there on your Teams, so you can download it from there as well. Try and solve it, all of you. Giving you 5 minutes in case you can solve it. In case you get stuck anywhere, please ask. Okay. So Sharon, please do it, and in case you get stuck anywhere, just let me know. In the meanwhile, I'll just check whether everything is there on your Teams or not. Okay. Okay, let me upload it. Okay. Then let me see the numericals. So I have uploaded all the material for ratios. Okay, so this has already been done. Chapter 7. Okay. Sharon, were you able to solve any? Aniket, are you also solving? अनिकेत तो कुछ बोल ही नहीं रहा है. Sharon, what about you?
Yes, ma'am. I was able to solve the current ratio and quick ratio.
Very good, very good. ठीक है, और करो.
मैम
हाँ समृद्धि.
मैम जो कैश फ्लोज के न्यूमेरिकल्स और सॉल्यूशंस है ना, आई थिंक वो अपलोडेड नहीं है.
कैश फ्लो के न्यूमेरिकल्स और सॉल्यूशंस कैश फ्लोज के.
यस मैम.
अच्छा रुक जाओ, हम वो भी अपलोड कर दे रहे हैं. अच्छा वो याद दिला दिया तुमने. ओके, इसको हटाओ. कैश फ्लो के इसको ना हमने कैश फ्लो के जो न्यूमेरिकल्स और वो है ना समृद्धि, दैट आई हैव रिक्वेस्टेड
यस
ये
मैम, ईडम को आपने.
टू टाइप. तो एक बार वो टाइप हो जाएगा ना तो उसको अपलोड कर देना इधर.
ठीक है मैम. ओके.
एंड नेचुरली जब हम लोग बाकी का अपना टाइप कर लेंगे, जब न्यूमेरिकल्स वो हो जाएंगे तो एक साथ हो जाएंगे फिर हम लोग के ना, इंस्टेड ऑफ मतलब अपलोडिंग ऑल ऑफ दीज अलग अलग.
ओके मैम. And ma'am, the calculation was right. It was if
मतलब वो क्या था वन वो
मैम
8. हाँ
वो 800 जो figures थी, like
हाँ.
the denominator was numerator was divided by 2 and denominator was also divided by 2. So what I did, I simply like वो
अच्छा
कट
मतलब
हो
तुमने
जाएंगे.
डिवाइडेड बाय टू अलग कर दिया, मतलब उसको
Yes ma'am.
कैंसिल कर दिया.
Yes ma'am. Yes ma'am.
ठीक है ठीक है ठीक है ठीक है. So Sharon, it's already 5. So I would encourage you to solve the rest also. ठीक है. And wherever you get stuck, then you can carry it back to the class as well. ठीक है Sharon.
Yes, ma'am.
ठीक है. All the best Sharon. Thank you so much Samriddhi. Thank you Sharon and Aniket. Samriddhi, please give me a call after the class is through. Huh?
Okay ma'am. Sure.
Thanks. Yeah. Bye.
Thank you ma'am.
Thank you.
Thank you, ma'am.